Good morning, ladies and gentlemen, and welcome to the AUGMENTUM FinTech PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab that's just situated on the right-hand corner of your screen. Just please simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure that would be most gratefully received by the company. I'd now like to hand over to CEO Tim Levine. Good morning, sir.
Good morning, and thank you to everyone who has dialed in. This is the first time we have worked with Investor Meet companies, so very much looking forward to hearing your feedback as well. My name is Tim Levine. I'm the CEO and founder of AUGMENTUM FinTech. I will spend around the next half an hour just taking you through where we've got to in terms of our results, give you a sense of the underlying portfolio, and then also talk through where we see the market more broadly going, and then keen to answer as many questions as I am able to do so. And as Mark has just suggested, please do kind of forward those in the Q&A bar, and at the point in which I've finished, we'll look forward to trying to answer those. So without further ado, I shall kick off, and ultimately hitting the headlines from the top. It's been another strong and positive year for AUGMENTUM. We have been listed now for 4 years, and when we listed in 2018, the NAV was 94 million, and we've been on a journey to grow it, both through NAV growth and also through issuing new capital. And I think for us, the vision for this fund is to ensure we have got a permanent capital base that gives us true scale in the market, that allows us to be relevant, allows us to continue to support our portfolio companies, but also be able to capitalize on the kind of ongoing opportunity in the European fintech market. So what does that mean? We're just under 300 million in net asset value. The NAV per share increase has been just under 25p. And the measure that we use in terms of tracking our progress, and I'll talk about it a little bit later, is the IRR, the internal rate of return on the point in which we invest our capital. And our internal target is to be tracking in and around 20%. And so far, we've largely tracked that and are tracking a little bit ahead of the internal benchmark that we are working towards. The other issue, which is particularly important in the current market, is to ensure you're well capitalized, recognizing that the ambition is to raise capital and to deploy that in a moderated way, but never to be sitting on too much cash and to avoid cash drag. I think over the past 12 months, we've recognized that the market has been particularly competitive. We felt in many respects it was overvalued, and we felt that it would be prudent to, one, maintain our valuation discipline, but also be in a position that as and when the market turned, we were in a strong position to be able to invest, both to support our existing portfolio, but also to capitalize on compelling new opportunities as well. And we continue to see a huge amount of opportunities. And I think one needs to very much separate what we're seeing in the macro environment in terms of, in the later stages in particular, valuations coming down, but also really understand that we are still very early in the market opportunity in terms of financial services going through that huge digital transformation. And ultimately, from our point of view, we feel that over the next 5 to 10 years, you're going to continue to see some very compelling and exciting businesses that will be built, some that are starting to be built, and some that are yet to come to market in any way. And 4 years in, we are also seeing the first signs of maturity in the portfolio, where those businesses that we have been supporting for many years, both within this fund, but also in our previous fund when we rolled in those assets, starting to kind of deliver some compelling returns. And the outcome with Aberdeen purchasing Interactive Investor was a very strong outcome for us as a fund, and hopefully the first of many. In terms of where we where we focus in particular in this presentation, perhaps where we've not given as much focus in the past, and purely from an investor point of view, has been, how we see valuations and how we navigate that. And I wanted to kind of in particular talk you through that as well. But firstly, here is a snapshot of where the portfolio sits today. And, over the past year, it's been incredibly important for us to build that diversification across those subsectors within financial services where we think hold the most potential. And I think, as we often talk about, it is as important as being right, but not being right too early. And so there are a number of sectors that investors often talk to us about and say, why don't you have exposure here? And we recognize the structural inefficiencies in those markets, the lack of digitization, the inefficiencies of the incumbents. But the challenges often are that, the market is not yet demanding the digital transformation that perhaps many believe is long overdue. And, you could argue that the insurance industry is one where there remains huge potential. There's a massive revenue pool to attack. But if you look at the overall kind of insurtech market, which is, how we would classify, those digital players, there has been a significant amount of venture capital that's gone into that, but we're yet to see in Europe an exited unicorn in the insurtech space. So we continue to track, monitor, build relationships with companies and sectors which we think hold significant potential. But ultimately, we do need to try and get our timing right. And, when you look at the portfolio, you can see, a real bias to the digital banking space, to the wealth and asset management space. And increasingly in the past couple of years, we've really started to build out our capability in the infrastructure space, which has seen some significant growth and a pretty diverse set of opportunities as well. And when you look at that kind of progression as well, it has been a steady period of growth from the initial portfolio, seed portfolio, which we rolled in, which included the likes of Zopa and Interactive Investor, raising that first initial amount of capital, and then starting to build out that portfolio to take us to the position that we have been in today. And I alluded to a little bit earlier the internal target that we're having, looking at that what is the measure that can determine our success. And I think it's really important to understand that in an ideal world, you would have this return realized. At any one point, you'll have capital invested. And once the portfolio starts to really move to the period of maturity, you can start to see those realizations come through. So this is a blended return of both unrealized and realized. And as I said, 4 years in, we're happy with the progress so far, but the true test of the fund will be 2 to 3 years down the line, once you've started to see a more significant number of exits that have come through. So where have we been deploying our capital over the past 12 months? We've deployed around 60 million in new capital into the portfolio. And in the first half of last year, a lot of that went into new opportunities in themes and thesis where we felt we were underweighted, businesses that we've been tracking and building relationships with over an extended period of time. As the year went on, we continued to feel that the market was being very significantly overpriced in parts, and it was increasingly clear to us that we needed to kind of maintain a high level of prudence and discipline, and looking very closely at the multiples that were being applied to both early stage and later stage growth fintech businesses in the European ecosystem. And I think when you look at the amount of capital that we deployed, it is a significantly lower number than it was in the first half of the year. But in particular, the bulk of that money, the vast majority of that money, really went into existing opportunities where we had a deep understanding of the businesses that we already had in our portfolio, where we're very active investors as board directors or observers, and felt they presented a compelling investment opportunity far better than some of those external new company opportunities that we were looking in the market. Not to say that we weren't busy. looking at new opportunities, and I'll touch a little bit later in terms of, why we weren't investing. The pipeline remains as kind of busy and compelling as ever, but ultimately it is a question of making sure that we are rewarded for the risk that we're going to be taking, and that when we do get it right, the returns really do, justify the entry price that we paid. Since post year end, we've invested in a new business, a business called Kemby in the payment space, which is an early stage business based in Israel. And payments is one area where we've been looking for some exposure, but increasingly is a fragmented and noisy market, and you are looking for really differentiated propositions in that place. And we believe that Kemby is one of those businesses that really does stand out to us. I'll touch on some of these points a little bit later, but this really is a summary. But if we look at the portfolio, and I talked about diversification across sectors, but it's equally important for us to have diversification across stages as well. We recognize that venture is a long-term investment opportunity, but ultimately investors simply don't want to sit there and close their eyes and wait for 10 years for that first exit. So our portfolio construction is built upon the fact that we need to ensure we have a larger number of businesses and investments at the earlier and mid stage. And in terms of the weight of our NAVs, so you can see in terms of our NAV here, it's about half is towards the later stage. So we can give visibility to investors that there will be a path to exit within a 2 to 3 year period. And you can see on the right hand side here, you've got investments that continue to grow at every stage, and it should come as no surprise that the early stage grows at a far quicker rate on average, albeit off a lower base. But you're starting to see that portfolio maturity even after the exit of II. And in terms of, where has that valuation shift, where has that write-up come? I think what is encouraging again for us in terms of our construction is that a lot of that uplift has come from those more established businesses, the businesses that are on that path to profitability, if not already profitable, that have raised capital in the recent months, and where we have a greater level of comfort and certainty that these are businesses that are way beyond their the path of product market fit, where we have over the next 2 to 3 years a number of plausible paths where the businesses could potentially exit, whether it's through IPO, whether it's through M&A, whether it's through a trade sale or something equivalent as well. So the likes of Interactive Investor, which we recently sold to Aberdeen, Grover, which recently closed around in April, so in the midst of quite difficult market conditions, and Tide and Zopa as well, both within the past 12 months have continued to grow and trade well and attracted high quality tier one investors as well. And the valuation question is probably the one topic that I've talked about with investors, both retail and institutional, more in the past 6 months than I have previously. And I think rightly so, because you can see here the yellowy orange line gives you the path that we have seen the listed high growth fintech index trade at. So this is at a forward multiple of revenue. And I think if you go back in time and you look at historic forward revenue multiples of growth businesses or SaaS businesses, you'd be looking at around 6 to 8 as that long-term average. And I think one of the measures that we've always used has been really looking at our core portfolio, so our top 10 assets that account for north of 70% of our overall NAV. And you can see since March 19, at the point in which we first had really kind of built the first cohort of companies in the portfolio, it's been hovering below that long-term average. I think what caused us pause for thought over the past 12 to 18 months has been seeing some of these benchmarks in the US in particular, and companies trading at unrealistic multiples. And I think you can see at one point the index traded north of 20, which was an unprecedented number. As we've seen the sell-off in the market, you have seen that come down. In fact, it's trading below historic norms at the moment. But most importantly for us, if you look at how we have valued our top 10 assets historically, we have not been guilty of following what we saw in the public markets, because we felt it was an unsustainable and unrealistic measure. And frankly, the true test of our portfolio over time is delivering positive outcomes and realizations rather than writing them up to unrealistic levels. And I think that's a really important point for us to continue to deliver to the market. It's a point of differentiation at times, and we'll continue to use that measure as we report to you over the kind of months and beyond. And so how do we manage valuation? And we are audited twice yearly, and the results that you are reflecting on now are our full year results. BDO would take our internal valuations and run the rule, and they'll use a combination of methods. In particular, the most common use will be the calibrated price of recent transactions, so the Seaport, which is for short, or they'll use public market comparables where they can see relevant benchmarks and companies in the market where they can apply. I think what's really important in that price of recent transaction is to look at, are you comfortable with the price that was paid, and can you then apply what we would define as an illiquidity discount? So if you had to sell that asset tomorrow, what is the price that you feel you would realistically achieve in the market? And often we would apply an illiquidity discount on top of the headline rate. So in some respects, we have one asset which has recently raised, but we felt it'd be prudent to apply a 20 to 30% further discount to that, just to give us a little bit of breathing space. So our philosophy and our approach is not about maximizing headline net asset value. We are not incentivized on that in any way. Our incentive is on delivering actual cash realizations across the portfolio, and not in writing up our NAV unless we feel that there is a strong conviction case in order to do so. And the other side of this, and this is a really important part of venture capital in particular, is you are backing early stage businesses. You are backing teams with exceptional capabilities often, but these are businesses still full of early risk. There is execution risk. And if you are going to pay a valuation which on the surface looks like a high headline rate for a business that perhaps has 1, 2, 3 years of track record, you do want to make sure that you are building some structure in there that gives you that downside protection. So we use two tools that is quite common in venture capital. One, which is a liquidation preference, i.e. if you are the last money in, then you are the first money out. So to give you an example, if you were to invest in a business at a £25 million valuation and you put in £5 million and that business was sold for £5 million, then you would get all of your capital back. In addition to that, and I think there's a fair bit of discussion about this in the market at the moment with some high profile tech companies that are doing raises at significantly lower multiples, what we like to put in is something called an anti-dilution clause. So in a scenario where you invested at 25 million and the next round ended up being at 10 million, then you would be compensated for that, what is called a down round as well. So if you look at our portfolio of assets, 19 of them have that structure in them. And the 5 that don't, 3 of them are profitable and 2 are actual funds, which we have invested in asset classes where we feel we don't have the deep domain expertise. So, those would be kind of the anomaly in the portfolio and a pretty small percentage of our NAV. So how is the portfolio tracking? And I think it's important to look at the year-on-year growth. And Q1, clearly, I think many have seen some challenging market conditions. And I think, what's really important here is, despite what we expect to be a challenging macroeconomic environment, you have businesses that are fundamentally in that growth phase. These are businesses that are disrupting very traditional sectors, often industries that have really struggled with their digital transformation. And irrespective of the macroeconomic conditions. These are businesses that should continue to grow, should continue to steal market share, should continue to onboard kind of new customers and new segments that feel the proposition is far more compelling, far more user-friendly, and fundamentally often at a lower cost than some of the incumbent propositions that they see in the market. So these are businesses continuing to grow on average at a pretty high rate. If you look at the average across the top 10, then you're looking at nearly 100% year-on-year growth, Q1 versus Q1 last year. And as important in this market, it is important to have a runway of capital. So we recognize that the capital raising environment is not as conducive as it was 12 months ago. And as such, we're looking for at least kind of 18 months of cash runway for these businesses. And that's something which we're tracking quite carefully at the moment, ensuring where possible, these businesses are being prudent with their cash where they can be, and it is not growth at all costs. We're looking for sustainable growth. We're looking for businesses that can have those strong unit economics, that can build a path to profitability. But absolutely, as fundamental, it is not about maximizing for profit. These are businesses often that are eating into markets where they have small market share, where there are huge potential total addressable markets, and where there is real opportunity, where we do not want to leave growth on the table, and maximizing for profitability would be a strategic error. So it's about having that sustainable growth, and fundamentally it is continuing to invest in that growth to ensure that they can grow at the right rate, but also maximize the market opportunity that is ahead of them. The point in which one starts to maximize perhaps for profitability is when that growth starts to dip, when you're on a path to exit, and in a scenario where potential buyers or perhaps you move to IPO, when the market will consider profitability an important measure and metric to allow that company to deliver the optimal outcome. And I think Interactive Investor is a great example of that, that had grown well, but had moderated that growth because the market was looking for the fundamental profit metrics that it ultimately delivered, and it did exit at a very strong multiple of profit in earlier this year. Now, I'm not going to dwell on the key assets. This is a little bit more detail, and I'm very happy for you all to kind of look through that, and we'll make sure that we share this presentation with you afterwards. But in terms of why is a specialist investor truly differentiated from many other generalist VCs, it is that we are building a thesis-driven approach, a bottom-up approach. And if you look at the 8 investments that we have made over the past 12 to 18 months, this is not about being reactive. This is not about seeing opportunities that come into our inboxes and say, oh, there's a good opportunity, let's invest in the pensions and savings space. This has been built up over the past few years, where we have built that thesis-driven approach, where we've looked at the portfolio construction and said, where are we underweight? Where we've looked at the market dynamics and said, where do we feel that the market has changed in the last 12 months that we want to build that exposure? And I think if you look at the payment space, when we looked at the portfolio 2 years ago, we felt we were underweight there. We hadn't built that domain expertise in the team, and we had hard in for that, and we were looking for assets where there could be real differentiation in a space which I referred to earlier as being quite fragmented and competitive, but still significant market potential. And I think that kind of holds true both across the pensions and savings space, across the market infrastructure. And then it is trying to be somewhat ahead of the curve. We talked earlier about not being too early, not being right too early, but I think credit refinancing has been a space over the last 12 months where we felt that there would be economic stress, where we felt that consumers in particular would be looking for refinancing of loans, and we felt there was a lack of digitized options that gave consumers the ability to refinance in a transparent and easy way. And if you look at the business that we backed in Sweden called Anyfin, which has built a very significant proposition both in Sweden and increasingly in Germany, we feel that is a market where they are incredibly well positioned to capitalize on, in particular over the next 2 to 3 years as well. So where do we go to in the market, and what has happened, and why have we seen such a big sell-off in the global markets, in particular in the US, in the listed space? And I think this really encapsulates what has happened, where 2021 was a year like no other, where you saw more capital than we had ever seen before go into the venture capital and fintech space in particular. And, you know, for us, it is an anomaly. We don't believe that it will continue to play out in that way. I think if you look at 2020 and you look at 2019, these are the types of amounts of capital that we would expect over the coming years to go in there. But ultimately, if you look at the stages, and we define the stages where we typically invest at the Series A, the Series B, and the Series C, you saw the Series C really grow at a rate that was unprecedented. And that was largely because you were having very significant investors, whether it was sovereign wealth funds, whether it was pension funds, whether it was very large hedge funds that were looking to come into the market for the first time to build what they felt was a beta portfolio, where they perhaps felt that they were late to the party and they needed to build that exposure at any cost. And that is the stage of the market that has come off most considerably, and there'll be some very high profile raises at lower levels that you will have seen in recent months. And I think you'll continue to see some of those as well. It doesn't mean that these businesses aren't high quality businesses. The question is, what is the right price for that business? And I think we saw a lot of deals done at unsustainable multiples. And I think the multiples, as we saw earlier, are starting to come back to the historic norm, and in some cases are well below that. And why haven't we seen that flow through into the market into the first quarter? And I think you'll see Q2 as well in a somewhat similar level to Q1. And there's that lag effect where you've seen investments made towards the end of last year, deals that were inked at the end of last year but only closed in the first quarter or even the first 2 quarters. And that is still to flow through. But as you get to the second half of the year, you'll start to see that dip come through, and in the first half of next year I think you'll start to see the norm. But what is equally important is we are not in a liquidity crisis. We do not have a cash crunch. What we have is a capital base which we define as kind of dry powder, where there is more capital in the venture capital space, in particular in Europe, than there ever has been before. We were undercapitalized as an industry, and what we do now have is the right capital base increasingly to allow our very best businesses to continue to be funded, not be sold too early, not have to move to the US. So we've built a fundamental, there's been a fundamental shift in our ecosystem. So for high quality assets, there is the capital available, and more capital than ever before. The question is, what is the right price? And the capital that is being deployed, we believe, will be deployed over the next 3 years rather than at the pace it was over the last 12 months. So more moderated pace, more sensible valuations, and we will also see an exit, a partial exit of investors that we hadn't seen in as active a way in our market as we've seen historically. And this is a great way of showing you the most active investors in venture capital in 2021, many of whom you would not classify in any way as traditional venture capital investors. And this really shows you the nature of how they have scaled back over the past few months, and we'll be continually tracking that. So it's fair to say we saw the entrance of a number of new investors. Yes, they continue to maintain a thesis in fintech in particular, but we recognize that they felt that they were probably overactive in many respects, and this really helped fuel some of that price inflation in the market, which will continue to moderate over the coming 12 months. But as we talked about earlier, separating the valuation challenges and the market opportunity is hugely important. So why should you continue to be excited about the fintech opportunity. And this really is the chart that you should kind of have as one of your key takeaways. Where we are as a sector is hugely behind other industries. So we're talking about attacking a revenue pool globally of 14, 15 trillion, depending on how you define financial services. And when we break that down by some of those kind of core sectors within financial services, you can see that the disruptors, the fintechs, are still in single digits in an aggregated way in terms of the penetration that they've made in that market. So there is a lot to play for. There is a long way to go. And ultimately, for us, our job is to try and identify some of the most exciting businesses that can start to, build scale and eat into some of this market share. But the macro opportunity in financial services, the digital transformation, relative to other industries, still remains significantly behind. And I think that is, where we remain incredibly excited. And there is, a lot of potential ahead for us to look to exploit. And why aren't the incumbents doing more to digitally transform? Well, it's not through lack of effort, it's not through lack of spending. They continue to spend, approximately $500 billion, an extraordinary amount on digital transformation. The challenge that they've had these are huge global Goliaths in many respects. And if you look at the stats to the left-hand side, the failure rate of these digital transformation projects or these innovation labs that are being created is extraordinarily high. So a lot of this money is being deployed ineffectively. And the attitude and approach of some of the largest global financial services players has been to change tack. So yes, they continue to invest on their own balance sheet and their own infrastructure. But in many respects, this is legacy infrastructure. This is legacy infrastructure that has been built up over 20 to 30 years and is very hard to unravel. So they're working directly with fintechs, in particular B2B fintechs. They're becoming increasingly acquisitive. And also, they're investing directly into these businesses as well. And there are a few examples on this slide that shows you some of the deals and investments that they're making. And increasingly, we're working very closely together with these global financial services players as co-investors, as partners, and inevitably they will be acquirers, as we saw with Aberdeen acquiring Interactive Investor a few months ago. So I talked earlier about deal flow and what is happening, and are we seeing the same level of opportunities? And yes, we are. We are seeing a lot of opportunities in the market. Our conversion rate is exceptionally low, and it is even lower than it has been historically. And if you look to the chart to the right, if I showed you this 3-4 years ago, then I would have been really concerned that we were seeing opportunities and not converting them once we get to term sheet. Historically, if we got to term sheet, we would expect to convert 80 to 90% of that. You'll see over the last 12 months that we lost nearly 2/3, if not a little bit more, of the term sheets that we put on the table. But ultimately, the challenge we found was that these were high quality fintech opportunities, riddled with what we would define as challenges, but ultimately they were very compelling in many respects, but we didn't feel that we were going to be rewarded for the risk that we were willing to take. And ultimately, we did not match the prices that were being asked for those deals. So we stepped away. And I think price discipline is incredibly important. And I think with the benefit of hindsight, it was absolutely the right call. And we'll continue to maintain that price discipline. We expect that conversion rate to improve, of course, over the coming 12 to 18 months as the market starts to go back to the historic norm. But if you look at the number of opportunities, and here is a snapshot which is taken out of our CRM system, something called Affinity, which maps every business that we interact with. We track it, we put it on our watch list, but these are the opportunities that we're currently looking at the moment. But the bar remains high, and the conversion rate of 0.4% is, it's there for a reason, that we've got to, back those exceptional companies, those exceptional founders that can try and execute in an increasingly competitive market. And as investors in Augmentum, I think that's exactly what you would want us to be doing. So as I wrap up, and just looking at the clock, just over 30 minutes, 3 takeaways that I'd love you to go away and reflect on. One, hopefully what I've got across is the opportunity ahead remains very significant from a market size point of view. From a maturity perspective, where we are in the maturity cycle is still early, but what we are seeing are fintechs that are being built at scale and still operating in a very large revenue pool with a lot of market share still to play for. In terms of our performance as a fund 4 years in, we are on track with where we expected to be. The IRR is tracking as we hoped. We are now at scale, just at around 300 million. We feel that the strategy can continue to scale and grow. The top 10, our core assets, are well funded and continuing to grow nicely. And as we really move into that first period of real maturity, we're starting to see those realizations coming through. And Interactive Investor is a great example of that, where we delivered 11 times our initial capital that we invested. But what we're not blind to the fact that the market goes through different cycles. We need to continue to be disciplined on pricing. We need to continue to make sure that we have that advantaged access to some of the most compelling opportunities, and we need to ensure that we're well capitalized to be able to capitalize on those opportunities as well. And this is where really kind of specialism really takes on its own momentum, where we feel that really gives us a competitive advantage, where we do have that deep domain expertise, where we have built that pool of data for companies across Europe in the fintech space, which we've been monitoring over the past 4 years and beyond. And ultimately, we will continue to both maintain this discipline, but also demonstrate that differentiation into the market. So I'm going to stop there and move to the Q&A.
That's great, Tim. Thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab, just situated on the right-hand corner of your screen. Just type in your question and press send. But just while Tim takes a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Tim, as you can see on the right-hand side of your panel, hopefully you can see the questions from investors that have come in through today's meeting. And I wondered if I may just hand back to you to read out those questions and perhaps give a response where it's appropriate to do so, and I'll pick up from you at the end.
Great. Well, I will answer them in order. So no particular theme. So I will go. Mark A has asked, which of your portfolio companies do you see as the most disruptive, and which offers the greatest potential? Good question. It often does depend which month you catch us in. I wouldn't want to single out a particular company. I think we have some companies much earlier in their evolution that are incredibly exciting, still have much to prove, and I suspect are businesses that you've not heard of. And I think it's our job is to move those businesses through the maturity cycle and continue to support them where they start to fulfill that potential. And I think it's an important point to make that in venture, you don't always get it right. You will have businesses that don't work, and you need to make sure that the ones that do more than pay for the ones that haven't quite delivered on those expectations. But if I look at some of our established businesses, I look at the likes of Tide, which has built 7% market share in the SME banking space, which is an extraordinary achievement. Or the likes of Zopa, which has been around a long time, and I think is a great example of their, fintech is not always an overnight success story. Businesses can go through some real cycles and some real challenges along the way, but that's a business that has built an incredible tech stack, an incredible ability to price risk and price it effectively, and an origination engine for consumer loans that is the envy of pretty much every neobank in the space. So those are kind of established businesses that I think over the next couple of years that you should keep a real eye on. And then you can look at some of these emerging businesses in the portfolio. You can look at the likes of Cushion, which is a workplace pension platform, digital platform, really capitalizing on the boom in auto enrollment, where there's been very little innovation or digitalization, despite the fact that the industry has really kind of only evolved since 2018. And I think that is one which you should also keep an eye on. Do you take board positions in your investee companies, and what input do you have on management decisions? Yes, I mean, fundamentally, we are strongly of the view that you need to be active in your portfolio companies, in particular at the early stage. So yes, we would take a board seat, we would take a board observer seat, and we would try and play an active role. And I think that's part of the motivation for both the companies and for us, is to make sure that they recognize that they take not only our capital, but our expertise as well. Because what we've done is we've built a team that aren't career investors. We've been career operators and entrepreneurs, and over this past decade, we've really kind of shifted across to the investment side, because we felt that the venture capital community was lacking that entrepreneurial and operator DNA. And I think we've got a really good blend of both being the operators, being the entrepreneurs, but also being the investors as well. And so we do take an active role, but ultimately we're minority investors. And yes, we have minority shareholder protections, but ultimately we are backing the management team and the founders to execute in an exceptional way. And, you know, that is hard, but ultimately when these businesses don't quite go to plan, it is often as a result of that execution. And this isn't private equity where you're buying majority and putting in your own management team. You are backing that management team often that go on a journey, and it's our job to try and anticipate some of those challenges along the way and help management, grow and scale. And if they don't, then that's when you have the kind of challenging conversations. But the good news is we've seen this story many times before. So a lot of the challenges and issues that companies come up against are ones in which we're not fazed by, and we're very familiar with. So how do you balance getting your entry price right versus missing an opportunity due to aggressive pricing and participation by others? Yeah, I mean, I think that's the billion-dollar question, really. You are willing to take a risk and you're willing to pay a high price if you have very high conviction, and it depends often at the point in which you invest. So we would sit there and we'd have our internal return models that would look at where we're investing, what do we think the minimum return needs to be for us to be rewarded for the risk that we're taking. So to give you some generic examples, at the Series A, we might sit there and say, do we see that this has a minimum of a 10x return? Can we put together our return model that has that? What does this business need to do in order for us to deliver a 10x return to investors? Perhaps at the later stage, we might move that to 5x, and even at the later stage where we're not as active, but if we feel something was compelling, we might sit there and say, can we see a 3x return where the risk is lower? So I think it's making sure that you apply the right multiples for the right stage of which you're investing. And as I've said a couple of times in the presentation, you are being rewarded for the risk that you are taking. And we miss many opportunities, one, because you can't be in every deal, but also because, as you saw earlier with the slide in terms of the conversion, we had built relationships with businesses for an extended period of time. And as much as we, we're excited about the business, we're excited about the management team, we couldn't reconcile that the price being paid made sense for us, and we had to delicately step out. Next question: what is the equity stake of the portfolio management team in Augmentum? Well, being listed, we buy shares. So what we don't have is a highly lucrative long-term incentive plan where we're being paid in shares. Ultimately, we buy our stock at the same price as everybody else, and we've done that since IPO. And off the top of my head, I'm going to give you a number that's probably around 2% of the equity which the team have bought. So we're bought in. We're inextricably aligned with our investors, and ultimately, if we want to buy more stock, which I know some of the team are doing at the moment, then we pay the current prevailing price. Question from Priyan. Thanks for the update. How much cash is earmarked for the existing portfolio versus new investments? Well, we said we had over £60 million of cash. The portfolio is well capitalized at the current time. The objective over the past 12 to 18 months, and we made it very clear to our portfolio companies that we felt the market was strong. It was a good opportunity to raise capital, which many of them did, and they have a strong runway. You would have seen that we have an average of 17 months of runway for those core assets. So the majority of the cash at the current time would be to be able to kind of capitalize on new opportunities. But we need to be prudent, and we need to recognize and see where the market is going. So we will leave, always leave a good residual amount of capital to ensure that we can follow in and defend and protect our positions. The first rule of venture is to back your winners and avoid dilution where you can, and that's really important for us. So I think for now, we don't have significant requirements within the existing portfolio, and we will see how the market develops over the next 6 to 12 months. And we're looking at a number of new opportunities at the moment, but ultimately the pricing has to be right. Do you have ambitions to be an evergreen fund, or do you expect to raise more capital as the market rewards the model by closing the discount to NAV? Yeah, it's a good question. I think it's a combination of both. Historically, we've traded at a premium to NAV, and I think that's justified because it's the NAV is always kind of backward looking. If you look at the rate in which our underlying portfolio companies grow, then it is an old NAV. We recognise that the current market, our peers, both in the venture and the private equity space, are all trading at significant discounts, and it's a scant consolation that we're trading at a lower discount. But fundamentally, we need to move that back to a premium. I think the model, as I said, can continue to scale, and I think we need to do that in two ways. We need to do that through growing the NAV, but also to raising further capital as and when the situation demands it. The question of at what point are you at scale? It's hard to be too definitive. I think if you ask me today at £500 million, and I think you are, you have a position where you have a real presence in the market, where you can adopt that evergreen approach. And in a scenario where we had an outsized return, and I hope we do, and we can't deploy that capital, then we would be very open to returning some of that capital back to shareholders if we felt that was the right decision. So we'll continue to be kind of open-minded, but no immediate need to raise further capital at the current time. We've got one more question. Are there particular subsectors within fintech which you are looking at for near-term investment opportunities? Well, I think we raise, you saw those 4 subsectors where we built exposure over the past 12 to 18 months, and we continue to look at those areas. But of course, they're not the only areas where we're active, and we're looking at a number of areas, as we have done for since IPO. So insurance is one which I talked a lot about, being a sector that holds huge promise, has been a little bit disappointing to date in terms of cut through, and I don't think we feel we've missed too many opportunities in that space by saying no more often than not. But at the same time, there are 1 or 2 areas and 1 or 2 companies in particular that we have been tracking and building relationships with over the past 18 months that we might or might not convert into an opportunity. I also think when you look at some of these big markets, and we can look at the big sector, the wealth and asset management space is enormous and very kind of, you could subdivide it in a lot of different areas. We continue to feel that when we look at the wealth management space in particular, it's been a particularly kind of disappointing area in terms of cut through. And one of the reasons that we invested in Interactive Investor, which, to be perfectly honest, when we did, was a bit of a digital dinosaur, we were pretty underwhelmed with what we were seeing in terms of the savings space, in terms of the innovation going on in robo-advice, where although these were kind of compelling products in many respects, building real scale businesses, and the unit economics of building those businesses weren't particularly conducive to what we thought was venture capital. And so, that was our play there. But we do see some innovative opportunities in that space, and we're certainly keen to see if we can capitalize. In particular, having just exited II, it's certainly an area of real focus for myself personally. Over the past 12-18 months, the only new opportunity that I personally invested in and led on has been kind of cushion in the auto enrollment space. And I'm spending a lot of time looking at that kind of wealth and asset management space and looking for those outlier opportunities that we can give our investors exposure to. So watch this space. I won't give away too much at this point, so we shall close it there.
That's brilliant, Tim. I think you've taken all the questions from investors today. So thank you to everybody for your engagement this morning. And Tim, if any further questions come through, we'll make those available to you after today's presentation. Tim, I know investor feedback is particularly important to you and to the company, and I'll shortly redirect investors to give you their thoughts and expectations. But before doing so, I wondered if I may, Tim, just ask you for a few closing comments.
Just to thank everybody for spending the time this Tuesday morning to hear us. I know there are existing investors and shareholders, and I know there are those that are hearing the Augmentum story for the first time. So we do have a lot of information on our website, augmentum.vc. You can also email me directly, tim@augmentum.vc, if there are any questions that you felt I haven't answered, or you thought of a question that you didn't ask today. We're happy to do our best where possible to answer those. And that's all from me, and look forward to doing this again in the not too distant future.
That's great, Tim. Thank you once again for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be highly valued by the company. On behalf of the management team of Augmentum FinTech PLC, we'd like to thank you for attending today's presentation. That now concludes today's meeting, and I wish you all a very pleasant morning.